All right, guys, welcome back to another video. Today we're talking about bonds, and we're going to unpack bonds a little bit here. Bonds are another valuable investment tool. I want you to discover what bonds are, how they work, and why they're considered safer investments than stocks. Now, have you ever invested in bonds before? Are you considering it? Listen, share your thoughts, comments, questions down below. I am excited to talk to you about it and explain what bonds are, answer any questions for you, or learn something from some of my audience that may have some experience with bonds and bond portfolios and their risk profile. Now, bonds are, of course, a valuable investment tool. Based on where you are in your financial life, you might need bonds more than you need stocks, right? If you're older and you have a large amount of money and you simply need to make sure that you have some income to spend on a monthly basis, let's say, then bonds could be a very big part of your portfolio. So what are bonds, guys? Bonds are debt securities. What is debt? Debt is when you are borrowing money from someone. When you are in the negative, you need 10,000, you borrow 10,000 from someone. Now that is called debt. You owe $10,000 to that person that loaned you the money. Now, do you get to borrow that money for free? Can I just walk up to you and say, hey, can I borrow $10,000? And you say, of course, here's 10,000. And I walk away and I say, I'll pay you back in 10 years. It doesn't work that way because there has to be some level of compensation for the value that I'm providing for you today. The value I'm providing for you today is $10,000. What are you going to give me in return? Well, it's called interest. It's how much you pay on the money that you've borrowed. It's a percentage of the money you've borrowed that you will pay back or pay to the individual that loaned you the money. And at the end of the term, you'll pay back the whole principal that you borrowed. So that's what bonds are. So they work in the way that you buy a bond for, say, $10,000. If the coupon on that bond is 5%, then every year you will be getting $500 from that company. And then you could decide on how you spend it. Or if you get it quarterly, then you would get $75 per quarter, or $125. So that's how bonds work. You buy a bond, which is loaning a company money, which is called the principal. If you buy it for $10,000, the bond has a coupon, and the coupon is based on the perceived and actual safety of your investment. Based on financial data and financial statements, you can determine how likely a company is to pay back their debt, especially not only from a absolute perspective, but also from a relative perspective. How likely are they to pay back their debt relative to other companies with similar or better or worse financial circumstances? Let's use the age-old comparison of Pepsi and Coke. Now, they're both strong companies. They both are long-standing businesses, and you would think they're equal. Well, that's what makes it a little bit different, right? Coke is a bigger company. Coke is a more profitable company, and it is a safer company, right? So you could loan $10,000 to Coke, and you could loan $10,000 to Pepsi. Pepsi probably has a higher coupon, right? Because of the financial data. It's not that the investment is any more likely to fail. It's just a matter of how safe it is, because in the event that it did fail or they were unable to pay, that would be reflected in the higher coupon that you've been receiving. Now, let's talk about why they're considered safer investments than stocks. Think about a bond from Coca-Cola. There's not much that can happen to that bond if Coca-Cola stays in business, right? If Coca-Cola stays in business and doesn't do as well as it did in the previous 20 years, it doesn't affect your investment as long as they can pay back the interest and the principal. Whereas though if you owned a stock and let's say Coca-Cola did not do as well as they have done in the past, then your stock, your equity value will be lower. So you will have lost money with your equity investment, but with your debt investment, with your bond investment, you would have taken no loss as long as they continue paying their coupon, and as long as they continue making money enough to pay back you principal, then you don't have anything to worry about. Now, what changes bonds prices though? Think about that. Now, this is much more of a market-wide phenomenon that affects bonds and the price of the bond, and that's the prevailing interest rates. So as interest rates rise, the price of your bond will fall. So your bond has a price, and that's why I said we can get into the weeds here when I start talking about these things. But your bond has a price that you could sell it for, let's say. It doesn't become any less valuable to you if you hold it to term. But in the meantime, as interest rates rise, the price that you could then sell that bond for on the open market gets lower. And I can explain that briefly in the way of today's price isn't yesterday's price, basically, right? If interest rates were 5% and tomorrow they're 6%, why would I buy your 5% bond? Because see, the coupon rate doesn't change because interest rates rose. The coupon rate is what you bought it for. It's a 5% bond. It pays 5%. The company, it doesn't matter to the company. But to you, it does if you wanted to resell it. So why would I buy your 5% bond today when rates are at 6? I could buy a 6% bond for the same price. Then that needs to be reflected in the price of the 5% bond because it falls. Same thing if interest rates fall. Why would I sell you the 5% bond for the same price as a 4% bond? My bond is better because you're going to get more interest from that bond. So my bond price is going to go up. All right. Have you ever invested in bonds? Have you considered investing in bonds? Now, most people have probably invested in bonds if you have through a mutual fund. I'm going to get into all that too. But it's a nice way to invest in bonds without having to worry about the individual bond, especially when you consider how much it costs to buy an individual bond. All right. Share your thoughts, share your questions. I'm excited to get into this with you guys. Tap in, DM me if you want to get into the weeds of anything that I discussed today. All right. Stay tuned for more. I'll be back to you tomorrow.